Welcome to Iron Financial. This is the channel where we forge stronger portfolios by cutting through market weakness. And today we are putting Gloo Holdings, ticker GLOO, on the anvil for a serious stress test. You know, this company is the very definition of a market paradox. It's a story with such extreme, such conflicting data points that most investors, frankly, don't know whether to run for the hills or dive in head first. On one side, you've got this narrative of explosive, almost unbelievable growth. We're talking triple digits. But on the other side, a stock chart that looks like it fell off a cliff. So, our mission today is to break this company down to its core components. We're going to analyze the steel, we're going to test the concrete, and we're going to determine if management is actually building a fortress that's set to dominate its market, or if this whole thing is just an elaborate house of cards ready to collapse at the first sign of trouble. The numbers are telling two completely different stories, and we're here to figure out which one is the truth.
Okay, let's get right into the heart of this thing. This slide, right here, lays it all out. This is the central conflict, the core tension that makes Gloo so fascinating and, let's be honest, so dangerous. Over on the left, you see a headline number that makes any growth investor on the planet sit up and pay attention. Fourth quarter revenue up an absolutely astonishing 418% year over year. I'm going to say that again so it sinks in. 418%. That's not a typo, folks. That is the kind of hypergrowth that can define market leaders, the kind of growth that builds empires. But then you look over to the right side of the slide, and you see the market's cold, hard verdict. The stock is trading near its 52-week low. It has been absolutely hammered. Now, look, these two facts simply cannot coexist peacefully in a rational market. This isn't just a minor disagreement between the bulls and the bears. This is a fundamental, structural disconnect between the company's reported performance and the market's belief in its future. So the question we have to answer is, what is the market seeing that the bulls are ignoring? Is there a deep, fatal flaw in this company's foundation, or is this just a massive market misunderstanding? A rare opportunity for those of us willing to do the heavy lifting.
And to figure that out, you need a blueprint. This is our plan of attack for today's stress test. First, we're going to dig a little deeper into that paradox we just talked about. Then our lead analyst is going to take the reins and construct the bull case, brick by powerful brick, using the company's own very impressive numbers. And after he's built it all up, well, that's when I get to come in with a sledgehammer and expose the cracks in that foundation, the bear case that has the market so spooked. From there, we'll dive into that disconnect between the Wall Street analysts who seem to love this stock and the market that's just selling it off. And finally, we will render our verdict. By the end of this analysis, you will know whether Gloo is a solid structure or if it's just smoke and mirrors. It's time to separate the hype from the hard numbers.
All right, let's build this case. Now, the bull argument for Gloo isn't founded on flimsy hopes or some vague futuristic story. No, it is founded on the most solid, the most undeniable metric in all of finance: top-line revenue growth. When a company is expanding at this kind of velocity, you absolutely have to pay attention. We're going to examine the raw power of their growth engine, the high-octane fuel they've just added to the tank, and the strategic roadmap that management has laid out to justify this massive ambition. So for the next few minutes, I want you to just forget the stock price. Forget all the noise. Just focus with me on the fundamentals of the business. And it all starts with that absolutely staggering headline number.
Just let this number sit there for a moment. 418%. That is the year-over-year revenue growth that Gloo reported for the fourth quarter of fiscal 2025, hitting $33.6 million for the quarter. You know, in today's market, a number like that, it just stands alone. This is not some pre-revenue biotech company hitting a one-time milestone. This is a technology platform that is scaling at a rate that is almost unheard of. This number right here is the concrete foundation of the entire bull thesis. And why is that? Because growth at this velocity can solve a whole lot of problems. It attracts the absolute best talent, it validates the business model in the eyes of your customers, and maybe most importantly, it shows that they are just gobbling up market share in their ecosystem at a breakneck pace. For the bulls, this isn't just a number. It's a statement of dominance. It proves the engine they've built is not only working, but that it's immensely powerful.
Now, this growth isn't just happening in a vacuum. Gloo isn't just growing, they are outperforming. They are just hitting their targets. They are crushing them. As you can see right here, they reported $33.6 million in revenue, which handily beat the Wall Street consensus of $31.6 million. That is a solid beat on the top line. But I want you to look closer at that second line, adjusted EBITDA. This is where the story gets a little more nuanced and, for the bulls, a lot more compelling. Even on their losses, they performed better than expected. They came in with a loss of $18.6 million, which is slightly better than the street's estimate of an $18.7 million loss. The critical point here is this. Management is telling a story of disciplined growth, and in Q4, they actually delivered on that promise. They beat on revenue and they managed their costs better than anyone anticipated. This demonstrates a level of execution that is absolutely crucial for any high-growth bull case.
In this performance, this is not a one-quarter fluke. This slide right here illustrates the trajectory perfectly. This isn't some sudden spike, it's a powerful, sustained acceleration. I mean, just look at the curve. They've gone from just $7 million in revenue back in fiscal year 2020 to nearly $95 million in fiscal 2025. That is not just growth, that is explosive expansion, a more than 13-fold increase in just 5 years. But look, the bull case is always forward-looking, and this is where it gets really interesting. Look at the guidance for fiscal 2026. Management has put a stake in the ground, and they've raised their guidance to $190 million. They are projecting with confidence that they will nearly double their revenue again in the coming year. When a management team has this kind of momentum and they feel confident enough to guide for nearly 100% growth on an increasingly large revenue base, it signals one thing loud and clear. They believe the market opportunity in front of them is massive, and they believe they are positioned to capture it.
So the skeptic's question is, okay, how are they going to achieve this? Well, they've been systematically fortifying the entire structure. Management hasn't just been out there selling, they've been building a financial fortress. First up, the IPO. They raised $72.3 million in net cash, injecting vital fuel for their growth engine. But critically, and this is a point a lot of people miss, they also converted over $143 million of burdensome debt into equity. This is a massive deleveraging event. It cleans up the balance sheet, it reduces risk, and it gives them huge operational flexibility. And they are using that newfound strength to expand their capabilities. The acquisitions of Westfall Group and Enterprise Market Desk, these are not random shopping sprees. These are targeted strategic moves to bolt on new services, creating a more comprehensive, more sticky platform for their customers. What they're doing is building a moat. And the catalyst, the accelerant that's being poured on top of this fire, is artificial intelligence. The CEO, Scott Beck, he made it explicitly clear in their last call. He said, and I quote, "AI is accelerating our momentum." Now, this is not just buzzword bingo to please the market. They are positioning themselves to be the definitive AI provider for the faith and flourishing sector. They've launched something called the Gloo AI Studio, and they're talking about agentic workflows, which is really just a sophisticated way of saying they're deploying autonomous AI agents to work on behalf of their customers, automating incredibly complex tasks. For the bulls, this narrative is unbelievably powerful. It reframes Gloo from just another software-as-a-service company into a high-tech AI play. And that, my friends, commands a completely different and much higher valuation multiple and growth expectation. This is their vision for the future, and you have to admit, it's a compelling one. Okay, hold on. I'll give you that. The lead analyst has just constructed a very impressive story. A fortress of growth, a deleveraged balance sheet, a powerful AI narrative. It's a beautiful blueprint, it really is. But if that foundation is so solid, if the momentum is that real, and management's execution is so sharp, then how in the world do you explain this? Because the market, the ultimate judge, it isn't buying a single word of that story. And the reason isn't based on some vague feeling or some abstract fear. It's based on a hard number that came out right after that beautiful Q4 report, a number that blows a massive, undeniable hole in that whole story of perfect execution.
-78 cents. This is the reported adjusted earnings per share for the first quarter of 2026, the quarter that came immediately after that magnificent Q4 performance our analyst was just talking about. Now, what was the analyst estimate? What was the target they were supposed to hit to prove that their story of disciplined growth was actually real? -39 cents. They didn't just miss the target, they missed it by 100%. This isn't a small crack in the foundation, people. This is the first major stress fracture appearing in the concrete. It completely undermines the narrative of disciplined execution, and it raises a giant red flag for any serious investor. It forces us to ask the really hard question. Is that powerful growth engine really under control, or is it just redlining on the verge of blowing up?
And that brings us squarely to the bear case. So now we're going to stop admiring the pretty architecture, and we're going to start checking the plumbing. We've seen the impressive facade, right? The towering revenue growth that gets all the headlines. Now it's time to inspect the wiring, to look at the cash flow statements, and to see if this entire structure is actually sound. Because while the bulls are all looking up at the sky-high potential, the bears have their feet planted firmly on the ground. And from down here, well, they see some very serious problems. I will concede this to the bulls. That engine is absolutely powerful. That 418% growth is real, and it is impressive. But here's the thing. An engine's power is completely useless if it consumes fuel so fast that it can't even finish the race. And that, in a nutshell, is the core of the bear case against Gloo. The cost of this growth is absolutely staggering.
This isn't some finely tuned, efficient machine. This is a top fuel drag racer designed for one thing and one thing only: explosive, straight-line acceleration. The problem is, it's burning through cash at a completely unsustainable rate, and the real question is whether it will run out of fuel long before it ever even gets close to the finish line of profitability.
Let's put some hard numbers to that fuel burn, shall we? Take a look at this chart. The net loss, it isn't shrinking as revenue grows, which is exactly what you'd want to see in a healthy, scaling business. No, it's widening dramatically. In fiscal 2024, the net loss was about $86 million. In fiscal 2025, that loss ballooned to nearly $159 million. It almost doubled. But the most critical number here, the one that should be keeping investors up at night, is cash flow from operations for fiscal 2025, negative $80.5 million. Let me be crystal clear. This isn't some paper loss from accounting tricks. This is cold, hard cash that walked out the door just to keep the lights on and generate that impressive revenue growth. The core business burned through over $80 million last year. That raises a very serious question of sustainability.
Now, Bull will immediately point to this slide, and you know what? They're right to do so. The IPO was a lifeline, and it did wonders for the balance sheet, at least on paper. They went from having almost no cash to over $57 million in cash and equivalents. And they did manage to slash their total debt in half, from $70 million down to about $35 million. This looks like a major reinforcement. But here is the bear's perspective, the lens through which the market is viewing this. That $57 million in cash, that's not a war chest, it's a runway. And when your business is burning $80 million a year just from its core operations, well, a $57 million cash pile doesn't look like a fortress anymore. It looks like a countdown timer, and trust me, the clock is ticking loudly.
And hey, I'm not the only one seeing these cracks. Let's bring in a third party, an independent, fundamentals-based analysis. According to Guru Focus, Gloo has a GF score of 12 out of a possible 100. That is an abysmal score, and it signals poor future return potential. But look at the breakdown. The financial strength rating is a catastrophic 2 out of 10. This right here brilliantly illustrates the entire bear case in just 2 numbers. Despite the fresh IPO cash, the underlying fundamentals, the profitability track record, the consistency of growth, the balance sheet health, they're all flashing code red. This suggests the structural integrity of this company is incredibly weak. That IPO wasn't a renovation, it was a patch job. A necessary repair maybe, but it did absolutely nothing to fix the fundamental, cash-burning flaws in this business's design.
Okay, so we have 2 completely opposing views, and both of them are backed by hard data. We have the bull case, built on this foundation of explosive, expectation-beating revenue growth and a powerful strategic vision. And then we have the bear case, built on the stark reality of massive cash burn, widening losses, and that shocking Q1 earnings miss. This brings us to the real core of the puzzle, this massive, glaring disconnect between what professional Wall Street analysts are saying and what the broader market is actually doing. How can one group see a skyscraper under construction while the other is pricing in an empty lot? Let's analyze that gap.
This slide just lays out the conflict perfectly. On the left, you have the market's verdict, and it is brutally harsh. A stock price of $6.16, hovering perilously close to its 52-week low of $4.63. The market is screaming risk. It's pricing in the cash burn, the EPS miss, and the profound uncertainty of any future profitability. But then, you look to the right. Wall Street's professional analysts, they're unanimous. Based on the 3 available ratings, the consensus is a buy. There are no holds, there are no sells. Every single analyst that is paid to cover this stock is telling their clients that this is an opportunity. This is a structural disconnect of a magnitude you just don't see every day. The pros and the market are in a complete and total standoff.
And it's not just some soft, tentative buy rating either. Let's just visualize the potential upside that these analysts are seeing. The current price is sitting right here at $6.16. The median price target from those analysts is $14. That represents a potential upside of over 127% from where we are right now. And the high target, which comes from a firm like Roth Capital, is all the way up at $17. So the crucial point here is that Wall Street isn't just bullish, they are pounding the table bullish. They are essentially telling their clients that the market has this completely and fundamentally wrong, and that the stock should be worth more than double its current price. They are betting that the revenue growth and that AI story will ultimately win out over the cash burn concerns. The market, at least for now, is aggressively taking the other side of that bet.
And so here we are, the final verdict. We've laid out the bull case in all its glory. We've taken a sledgehammer to its weaknesses with the bear case, and we've examined the stunning disagreement between the analysts and the market.
It is time to bring it all together for one final stress test. Is the foundation that the bulls see solid enough to support all that future growth, or are the cracks we've identified signs of imminent structural failure? Let's put the core arguments side by side one last time.
On the bull side, the foundation looks incredibly strong. You have that undeniable 418% Q4 revenue growth. You have management confidently raising guidance to $190 million, projecting a doubling for next year. You've got a powerful, forward-looking AI narrative that could command a premium valuation. And you have a balance sheet that was just fortified with IPO cash and a massive debt-for-equity swap. But on the bear side, the stress fractures are just impossible to ignore. A colossal Q1 EPS miss that calls management's execution into question, a staggering annual net loss of nearly $160 million, an operating cash burn of over $80 million a year against a cash balance of just $57 million, and just abysmal fundamental scores from third parties that suggest the entire structure is fundamentally weak. You could not have a more polarized, more conflicting set of data.
So what is the path forward from here? What should investors be watching? It really all comes down to this. The bulls need to see management deliver, period. The company is guided for approaching adjusted EBITDA break-even by Q3 of 2026 and actually achieving profitability in Q4 of 2026. If they hit those milestones, the bull case is proven right and the stock could re-rate dramatically higher. This is a pure bet on management's execution, and the bears are betting against precisely that execution. They are betting that the high cash burn is unsustainable, that the Q1 miss was not an anomaly but a sign of things to come, and that the company will either run out of money or be forced to raise capital on terrible, dilutive terms long before they ever reach profitability. This is a high-stakes race against time, with the company's cash balance serving as the clock.
Which leaves us with one final, critical question. This is what you, the investor, must ultimately decide for yourself. All this activity, all this revenue growth, all the AI talk, is this the difficult, expensive, and messy work of pouring a deep, solid concrete foundation for a future skyscraper? Or is this just a company spending a fortune to erect elaborate and impressive-looking scaffolding around what is, at its core, an empty lot? The market is currently betting on the scaffolding. The bulls in all of Wall Street are betting on the skyscraper. Your job is to decide which structure is real. Thank you for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.